Well, this is going to be a long note because there is a lot to discuss today, and as expected, everything revolved around the actions of two very different central banks. Let's start in Moscow. The Central Bank of Russia, as expected, or hoped anyway, did indeed intervene to prop up the ruble. That meant that the ruble closed at about 61 to the dollar. That represents a very significant stabilization, although you should note that it was stood at 56 to the dollar before its rather badly misjudged rate rise last Friday. As for the Russian stock market, the RTS at one point was up 28% from its low on Tuesday. Nice money if you can get it. That said, by the close it was almost exactly where it was at the close on Monday before the central bank did its midnight rate rise. Now, this is all fed through into some extremely exciting trading in oil. Brent, at one point, having fallen to start the day, gained 8% in a matter of hours, then gave up about 5% from there. At the end, Brent is still at around about $61 to the barrel. Still looks remarkably cheap compared to where it was 6 months ago. Now, in the US, the big news was all in this. The statement issued by the Federal Reserve after its December monetary policy meeting. The critical points, I think, to make about this, we also heard from Janet Yellen herself in her press conference. They are now very keen to say that they're going to be patient about normalizing interest rates, rather than saying necessarily that it's a considerable time from now. Asked to define this, she said at least not the next two meetings, which means that the first possible date for a rate rise is next April. Most people continue to expect it'll be more like the summer. She has also made clear that she intends to be data dependent. She described the remarkable reduction in inflation and inflation expectations as transitory due to the oil price. She managed to get through the entire press conference without ever once mentioning Russia, but she did want to emphasize, even if she was getting people ready for a rate rise next year, that interest rates are going to stay very low and accommodative for a very long time. We're now moving from focusing on when rates rise to how slowly they rise once they start to rise. How was that reflected through the markets? Well, it was obviously more hawkish than the Forex market was expecting, because the dollar gained more than 1% for the day against on a trade-weighted basis. As for inflation break-evens, well, the two-year break-even actually went negative for the first time since the crisis. Go figure. As for the S&P, the stock market, it had its best day of the year, and it's been a good year, up more than 2% by the close. What precisely is going on? We have a data-dependent Fed. The chairman is doing her best to give herself a lot of room for manoeuvre, but broadly speaking, people in the equity market are still hopeful that means that we will have very low rates for a long time to come, while the foreign exchange market is still braced for a very stark divergence between the Fed and the other main developed market central banks. This then leads us to the big question of the moment, which is whether we're going to party like it's 1999. Back in 1998, there was a crisis in Russia, much worse than this one. As a result, the Fed felt compelled to cut rates at a point when it otherwise might have been raising them. One of those moves was actually made between meetings. It had a whiff of panic about it. And that seemed certainly to spur the remarkable tech bubble at the end of the 90s. What we're showing you here is the path of the Fed funds rate compared to the price earnings multiple on the NASDAQ composite. So you can see that when those rate cuts were announced, the NASDAQ was trading at a high but not mad multiple of 25 times earnings. By the time the Fed tried to tighten things up again, started raising rates, it had gone up to a quite ridiculous level of 95. There is still a fear out there that the emerging markets will see capital flow out of them and into the US, that the Fed will stay too easy for too long, and you could get a repeat of that kind of melt-up, that kind of bubble. Janet Yellen was certainly trying to persuade people that if the economy moves on cue, you will see rates begin to rise next summer, and then we can avert that. That, I suppose, is the critical question now, which remains open after the Fed's statement. Are we going to party like it's 1999?